After a wait of 6 months, the LIC IPO has finally hit home. In what will be the biggest IPO in the Indian stock market's history, the government is selling 3.5% of its 100% stake to raise a mammoth 21,000 crores from the public.
Over in India, the country's largest life insurance company is going public.
LIC, or the Life Insurance Corporation of India, has exerted a towering presence over the nation's economy ever since the government combined 245 private insurance companies in 1956 with a mandate to offer life insurance to all sections of the society. For many Indians, insurance is still synonymous with the company, even after the industry opened up to private companies in 2000. And not just that. Over the years, it has been used by the government to support markets and bail out failed companies, as in 2019 with the IDBI bank fiasco. Using the policyholders' hard-earned money to rescue crony capitalists or state-owned firms would now hopefully become a thing of the past with LIC going public. In today's video, we are going to know 4 risks ahead of LIC. So, let's get started. The number one problem is the shareholder-policyholder dilemma. LIC is indeed huge and of a size comparable to none. Bigger than the 23 private sector life insurance companies put together, it manages close to 31 trillion in assets out of India's 40 trillion insurance industry. It sells 3 out of every 4 life insurance policies sold in the country. And until now, the only shareholder it was liable to was the Government of India. However, when you become a publicly listed company, you become liable to multiple shareholders. Meaning, you have to focus on maximizing the value for all the investors, which includes both the policyholders and the shareholders. And therein lies the first problem. Until now, every year LIC had been giving back roughly 95% of the profit generated back to policyholders and remaining 5% to the government. This was great for LIC policyholders. They used to get the expected payout from their insurance plan and a lion's share of the company's profit pool. However, now LIC will have to follow the private insurance company's route to keep both the policyholders and the shareholders happy. Now what is happening? Instead of the life fund, we have 2 separate funds. One is the participating fund and the other one is non-participating fund. To put it simply, the fund collected in the participating fund is for both the policyholders as well as the shareholders of LIC, while the fund collected in the non-participating fund is only for the shareholders. Why not for the policyholders, you ask? That is because the policyholders of LIC's non-participating policies like the ULIP plans or the guaranteed return plans are not dependent on the performance of LIC, as the name non-participating suggests as well. Hence, the policyholders get neither the profit nor the loss of the company. Now let us quickly understand this in the Excel. In the old method, there was only one fund, that is life fund. So if we had earned a profit of rupees 100, then 95% of this profit will go to the policyholder and 5% of this profit, that is rupees 5, will go to the shareholders. Under the new method, we have 2 funds, participating fund and non-participating fund. Of the 100 rupees profit that we have earned, 70 will go to the participating fund and 30% will go to the non-participating fund. Now, in this participating fund, 90% will go to the policyholder. That is why 70 into 90% is equals to 63. 63 will go to the policyholders. And 7, that is the 10% of 70 rupees will go to shareholders. Now, in the non-participating fund, there is 30 rupees, that is 30% of the profit. Of this, 100% will go to the shareholders and there is nothing for policyholders in the non-participating fund. Now, although this move has helped LIC increase its embedded value, the most important metric used to analyze insurance companies. Now, this embedded value is the common industry standard, but LIC has been able to achieve so because of its new method of profit distribution. And therein lies the problem. The major reason why LIC has dominated the market to date is the high bonus and dividends it has traditionally offered on its policies. A structure that prioritizes the interest of policyholders above everything else. With that structure falling, it is difficult to see why LIC policies would continue to attract the most. And if the business's future growth prospects take a hit, shareholders wouldn't make a lot of money either. So whether this trade-off will turn out to be successful or not is something we cannot say for sure today. The number two problem is the government itself. Even after the 3.5% disinvestment, the government will still own 96.5% of the company, which means the government would still continue to have the power to order LIC to bail out failed companies or force them to make investments favoring its interests and not necessarily being great investment decisions. The most recent example of that is in 2019 with IDBI Bank. The bank was bleeding money. More than a quarter of its loan book had gone bad. And LIC just walked in with 21,600 crore and bought a 51% stake in the company. At that time, LIC said this was a strategic investment in a large bank selling insurance. However, insiders believe LIC had to walk in because the government wanted somebody to rescue the bank. So maybe the real question we need to ask is, what about LIC's dubious investments? After all, we all know about how LIC has massive amounts of money invested in companies that are plain struggling or on the verge of bankruptcy. DHFL, Reliance Capital, Yes Bank, ILNFS, Reliance Home Finance, to name a few. All these big firms have defaulted on their payments of at least 32,000 crores as of December 2019. These investments have gone bad and the chances of recovering these funds is slim to none. So, despite being the biggest insurance company in India, it doesn't have full control over its investment decisions. The number three problem, which by the way is something you will only find mentioned in LIC's red herring prospectus, but surprisingly enough, no one in the media seems to be talking about it. And that is the inflated growth expectations of the insurance sector in India. You can read the entire statement on page 58 of the red herring prospectus. I will share the link in the description. But to give you a gist of it, it basically reveals, because of SEBI's fear of course, that the rate of growth of life and health insurance industries in India may not be as high or as sustainable as the industry anticipates today. The board members of LIC agreed that the low penetration rate of insurance in India does not necessarily mean that the Indian life insurance industry will grow as rapidly as many are projecting it to. According to CRISIL research, India's life insurance penetration stood at 3.2% in 2020 compared to 4.4% in 2010, and this fall has got a lot to do with the slowdown in our economic growth as a nation and also due to certain regulatory changes. The fourth problem is losing consistent market share to private insurance companies. From occupying 75% market share in 2014 to 65% in 2022, LIC has been losing its space to private players in recent years. While LIC's market has been limited to low and middle income group, private players have carved their way into upper middle income group and high net worth individuals with their diversified products and ease in technology. And while the pandemic didn't affect the private players at all, as they continued to get good business from online web aggregators, it created havoc for LIC as its business heavily depends on its huge agent distribution network, which by the way is second to none in the country. The pandemic brought this entire model to its knees, from restrictions on agents' ground movement to delay in IRDA's recruitment exam for new agents. The impact of this was quite evident when the number of LIC's active individual agents decreased by 17.48% from 10.86 lakh on 31st March 2021 to 8.96 lakh on 30th September 2021. With 94% of its policies being sold by the agents, if LIC is unable to retain them, it will definitely hit the company's financials hard in the short run. But in the long run, with the increasing cost of reaching every Indian household, it is difficult to see how an agent coming to your house multiple times to sell a plan can compete with these digital private players. A more prudent choice by LIC would be to strike a balance between both, partner with online web aggregators, or at least improve your own tech game while continuing with the agent model, especially for the inaccessible rural areas. Now, these were some of the major challenges that lie ahead of LIC. But as I say, never doubt a lion's strength, and in this insurance jungle, there is surely only one lion. The future of LIC will be judged on several parameters. While huge assets, trust and credibility are some of LIC's biggest strengths, its structure and operation do have certain bottlenecks, as we discussed in this video. But then, LIC is one horse you should never bet against. Not for any financial gain, but for it being a precious jewel of our country. Until next time, namaste, bye-bye and take care.